10 various types of mortgages you should be aware of. Most likely, you'll also require a house loan when you purchase a property. But how can you know which type of mortgage to buy when there are so many on the market? We examine some of the most popular home loan kinds and the potential borrowers for each. 1. Variable rate mortgages. The majority of homebuyers opt for a variable mortgage. According to the official cash rate set by the RBA, the lender in this sort of loan may raise or lower the interest rate. This implies that the interest rate you agreed to will probably not be the same as the interest rate you pay for the whole loan term. The amount you must pay each week, fortnight, or month will fluctuate if the interest rate does. Your repayments can increase or decrease based on whether the rate goes up or down. Advantages of a variable mortgage. You're likely to obtain a decent price because variable loans are popular and the market for them is competitive. You may anticipate paying close to what's fair because the interest rate on a variable home loan typically fluctuates in accordance with official rates. Offset accounts and redraw capabilities are two features that frequently come with variable loans that can help you pay off your mortgage faster. If you refinance or pay off your mortgage, for instance, you may often stop the loan early with no expense. A variable house loan could be suitable for whom? Although, you should always examine your ability to continue making payments. If interest rates rise, the majority of house purchasers should at least think about a variable home loan. Variable mortgages are best for borrowers who wish to have the option of paying off their debts early. However, a variable home loan could be the best option for both homeowners and investors. 2. Fixed-rate mortgage. For a specific length of time, often 1 to 5 years, the lender sets the interest rate on a fixed-rate mortgage. As a result, your payments will remain the same during that period. No surprises exist. Your interest rate will often revert to the typical variable loan rate at the conclusion of the fixed period. You will frequently also have the choice of fixing it once again for an additional period at current market rates, nonetheless. Many lenders will allow you to fix a portion of your mortgage while leaving the remaining balance with a variable rate. A house loan with a split rate is what this is. Advantages of a fixed-rate mortgage. Your budgeting process might be aided by having the assurance that your repayments will remain the same over the defined time. If you anticipate an increase in interest rates, this is an excellent alternative since you will be protected against any increases throughout the set period. Although often fixed-rate loans have fewer features than variable-rate loans, that isn't necessarily the case nowadays. Who may benefit from a fixed-rate mortgage? Borrowers on a tight budget who need the security of knowing the amount of their repayments. People whose circumstances could change shortly and who thus cannot pay higher rates, are buyers looking to save money and who anticipate an increase in interest rates. 3. Mortgage loan packages. Package loans account for around half of all mortgages. With this loan type, your mortgage is combined with various financial products like a credit card, mortgage offset account, and transaction account by your lender. Then, often, they only charge you one cost for everything. As part of a package home loan, your lender will frequently provide you the option of a variable rate, fixed rate, or split rate loan. Advantages of a package mortgage. Most of the time, you'll receive a discount on your interest rate, allowing you to save money. Additionally, it's common to find lower prices on services like financial counseling and insurance. Who may benefit from a home loan package? Owner-occupiers who will make use of the bundled loans features, such as an offset account, and who value the convenience of having all of their banking in one location. 4. Basic mortgages. Package house loans are essentially the antithesis of basic home loans, sometimes referred to as no frills or cheap home loans. They frequently have limited features but provide a low, frequently fluctuating, interest rate. However, you may not have access to a redraw facility or a fee-free offset account with many basic house loans. This implies that it can be challenging for you to access any additional loan repayments you make. Benefits of conventional mortgages. A low interest rate that lowers the required minimum repayments and facilitates early repayment. The ability to incur no costs and make any number of additional payments. Basic loans sometimes offer to provide an interest-only payment option, which may appeal to investors. Who could qualify for an easy house loan? Borrowers who desire a speedy and inexpensive payoff of their mortgage. Borrowers who don't want all the extras that come with a package loan. 5. Home loans with principal and interest. A mortgage is made up of two components, the principal or total amount borrowed, and the interest paid to the lender on that sum. Your mortgage payments go toward both principal and interest when you take out a principal and interest loan. This often implies that your payments will be higher in the near term for a principal and interest loan than they would be for an interest-only loan. On the plus side, as long as you continue making loan payments, you will ultimately own the property at the conclusion of the loan period. What advantages do principal and interest mortgages offer? Most borrowers want to someday become outright owners of their properties. Even if you want to sell your house at some point, a principal and interest loan will assist you to achieve this goal by increasing the equity in your property. Loans with principal plus interest often have interest rates lower than loans with interest-only payments. Over the course of the loan, you typically pay less interest since you are repaying the principal. A principal and interest home loan might be sued by anybody. Most homebuyers take out principal and interest mortgage loans in order to one day purchase their homes. Borrowers seeking to increase their property's long-term equity. 6. Mortgages with simply interest. In an interest-only loan, as the name suggests, your early payments solely go toward paying interest and you don't even scratch the surface of the loan balance. The period of most interest-only loans is constrained. For instance, the first 5 years of a 30-year loan may be interest-only. Once this period is up, the loan usually converts back to a principal and interest loan, forcing you to refinance or pay off the debt faster. As a result, they can eventually cost more than principal and interest loans. Advantages of interest-only loans. Reduced payments, at least while the loan is interest-only. If the loan is for an investment property, there may be tax advantages. The opportunity to invest in real estate and benefit from a growing market without having to spend a lot of money. Who could qualify for an interest-only loan? Borrowers who desire to temporarily reduce their repayments but raise them over time. Investors who qualify for interest-only loans' tax advantages. Investors that desire to divert their profits to other forms of investing. Investors want to profit from rising real estate values without making a sizable commitment. 7. Guaranteed mortgages. A loan that is further secured by the property of another person, often a member of the borrower's immediate family, is known as a guarantor house loan. As an illustration, a parent may provide their house or another piece of real estate as additional security for their child's mortgage. A guarantor used to be responsible for repaying the entire loan if the borrower failed to make their scheduled installments. Many lenders now provide family members the opportunity to serve as partial or limited guarantors, often for the first 20% of the loan, to assist lower this risk. Advantages of guarantor loans. It could be simpler to meet the requirements of lenders, which might allow you to borrow more money than you otherwise could. The opportunity to avoid making payments to lenders if you don't have a 20% down payment. Who may be sued for a guarantor loan? Borrowers who are capable of making regular payments, but lack a sizable deposit. 8. Access to credit. Compared to most house loans, a line of credit operates somewhat differently. This is because it gives you permission to borrow money up to a specific amount. You are not required to utilize all of this, though. Interest is only charged on amounts borrowed. A line of credit often has a variable interest rate, which is frequently a little higher than the rate on conventional house loans. Advantages of a credit line. It is adaptable. Because you have flexibility with your loan terms, you may obtain more funding without needing to apply for a new loan. You only pay interest on the amount you actually utilize, unlike conventional loans that give you a single payment. Who could be eligible for a line of credit? Those purchasing a house with the intention of renovating want to be able to access finances over time. Buyers seeking a more affordable alternative to a personal loan for accessing cash for other needs, such as a vacation or automobile. 9. Loans for construction. People who are constructing a home or making substantial structural changes are eligible for construction loans. They are made to consider how a building contract operates. The norm for builders is to request ongoing progress payments. This is why construction loans allow you to borrow each of these sums as they become due through a progressive drawdown. Typically, construction loans are interest only for the first year, before switching to principal and interest loans. Advantages of building loans. You don't pay interest on the entire loan principal until the building work is finished, since you only pay interest on the amount you pulled down. Your builder won't get paid if the job is delayed or subpar, since your lender won't release the money until they are pleased with the builder's performance. Who may bring a construction loan claim? Borrowers who construct their own homes or carry out extensive structural renovations. 10. Bridge financing. Before you have sold your present house, a bridging loan provides you with the funding you need to buy a new one. The typical length of bridging loans is 6 months or until you sell your property, whichever comes first. They are often interest-only loans. You typically don't have to make any significant repayments with a bridging loan during the loan duration. Instead, interest builds up until you make a settlement, at which point it is applied to the remaining loan balance on your new house. Additionally, bridging loans frequently have higher interest rates than regular house loans. Advantages of a bridge loan. Enable you to make a faster decision by allowing you to purchase a property before you sell your existing one. You may be able to borrow up to 100% of the value of your future house and not need to have a deposit saved in order to purchase your next residence. Repayments may be postponed until you move into your new house. Who could qualify for a bridge loan? Homeowners looking to buy their next house who already have a large amount of equity in their current residence. Those who are convinced they can sell their home within the bridging loan's duration,